Hello, financial history followers. Governments and central banks promise us financial freedom, stability, and prosperity. But have you ever wondered why, despite working harder, does the value of the money in your wallet seem to drop every single year? Why has buying a house become almost impossible for so many? It's because the financial system you're told about is not actually working for you. Throughout history, financial systems have often been designed for one primary purpose: to transfer wealth upwards, from the people to the elite. This isn't a modern conspiracy, it's a historical pattern. Let's travel back to ancient Rome for a moment. When emperors ran out of money for their wars and lavish lifestyles, what did they do? They reduced the amount of precious metal in their silver coins. They debased the currency. The average citizen on the street might not have noticed at first, but the purchasing power of their money quickly vanished into thin air. This was one of history's first major, state-sponsored wealth transfers. Fast forward to today, we're no longer dealing with silver coins, but the tricks are far more sophisticated, much more hidden. Modern states and their central banks use three major financial mechanisms to, effectively, keep you on a treadmill and centralize their power. These are inflation, bailouts, and quantitative easing. Here, at the Financial History Files, we're going to put each of these mechanisms under the microscope, one by one, and expose how they really work. So, get ready. Because these are the sharp, crucial lessons you won't get in school. I promise you, when this video is over, you will never read financial news the same way again. So, let's dive right in with the deadliest and most insidious trick of all. Trick number one, the invisible tax, inflation. So, what exactly is inflation? You hear the term everywhere, but it's often missing. At its core, inflation is an invisible tax that silently eats away at the value of your money. It is the reason that the $10 in your pocket today buys less than it did 5 years ago. Think about it. What was your rent or your weekly grocery bill back then compared to now? That's inflation in action. But where does it come from? A primary driver is when central banks create vast amounts of new money out of thin air. It's simple supply and demand. When the supply of money increases dramatically, but the amount of goods and services in the economy stays roughly the same, each individual dollar, pound, or euro becomes less valuable. Its purchasing power is destroyed. They call it stimulating the economy. But for the average citizen who saves their money, it's a slow and steady bleed. It punishes savers and rewards debtors. It is, quite simply, a tax you pay without ever seeing a bill. Now let's move on to our second trick: bailouts. This one is a little more obvious, but just as damaging. The principle is simple and infuriating. Profits are privatized, but losses are socialized. Let me explain. When large corporations, or more specifically, giant banks, make risky bets and win, those profits go to their executives and shareholders. Private profits. Fantastic for them. But what happens when those risky bets go horribly wrong, threatening to bring down the entire system, like in the 2008 financial crisis? Do those institutions bear the full consequences of their actions? Rarely. Instead, the government steps in, using your money, taxpayer money, to bail them out. The losses are socialized. They're spread across the entire population. You, the taxpayer, end up footing the bill for the mistakes of the powerful. This creates a dangerous situation called moral hazard, where these institutions know they can make reckless bets because they believe they'll be saved if things go south. It's a safety net for the rich, paid for by the poor and middle class. And that brings us to the third and perhaps most complex trick: quantitative easing, or QE. This sounds complicated, but the concept is straightforward. When the economy is struggling, central banks create new digital money and use it to buy financial assets, mostly government bonds, from commercial banks. The stated goal is to lower interest rates and encourage lending and investment. But what is the real-world result? All this new money floods into the financial markets. It doesn't typically flow down to the average person's pocket. Instead, it massively inflates the prices of assets that the wealthy already own: stocks, bonds, and real estate. This is why you see the stock market hitting all-time highs, while the real economy for everyday people is stagnating. QE directly contributes to the widening wealth gap. It enriches the existing asset owners It makes it incredibly difficult for the younger generation, or those without significant investments, to ever afford a home or build real wealth. It pulls a ladder up behind them. So, let's recap. We've talked about inflation, the invisible tax, bailouts, which socialize losses, and quantitative easing, the engine of the wealth gap. These three tricks, in different forms and under different names, have been used for thousands of years. From the debasement of Roman coins to the complex digital money printing of today, the fundamental purpose remains the same. A systemic transfer of wealth. There's a saying, history doesn't repeat itself, but it often rhymes. I'd say it's more direct than that. If you don't understand the financial history that got us here, the system will crush you without you even knowing why. But I didn't make this video to leave you feeling helpless. Knowledge is power, and understanding the game is the first step to not losing it. So, what can you, the individual, do to protect yourself and even thrive? Here are 3 concrete steps to build your own personal financial defense. First, and most importantly, financial education. You're doing it right now by watching this. Keep learning. Read books, listen to podcasts, watch videos that challenge the mainstream narrative. Understand what money is, how debt works, and what an asset is. The system preys on financial ignorance. Don't be an easy target. Second, avoid bad debt like the plague. There's a difference between good debt, like a sensible mortgage or a business loan, and bad debt, high-interest credit cards, car loans for depreciating vehicles. Bad debt is a chain that ties you to the system, making you a perpetual servant to interest payments. Live below your means and break those chains. And third, focus on acquiring real wealth. This doesn't just mean money in a bank account, which we know is being devalued. It means acquiring assets that hold their value outside the traditional system. This could be hard assets, but more importantly, it means investing in yourself. Your skills, your knowledge, your business, your network. These are assets no one can inflate away. They are the ultimate source of your financial security. By educating yourself, avoiding the traps of bad debt, and focusing on building real, tangible value, you can begin to opt out of the game that's rigged against you. You can build your own lifeboat. Thank you so much for joining us on this deep dive into the financial system. If you found this information valuable and it opened your eyes, please hit that like button. And more importantly, subscribe to the Financial History Files for more lessons the system doesn't want you to know. Stay curious and stay informed.